Hello, hello, everyone. Welcome back to Signal or Noise. Charlie Bilello here with me, as always, Peter Mallouk, episode 25. We got a lot of interesting topics. We're really going to run through these quickly. First, higher for longer. There's an upside and a downside to this. We're going to run through this. An insult to drunken sailors. That would be the way the U.S. government is spending money. Not all risk is rewarded. This is an important concept for all investors to understand. And we're going to end, as we always do, Peter, with signal or noise. So taking a look at stock bond correlation. So let's dig in. Big news, obviously, higher for longer. We got a Fed meeting today. We're recording this before the meeting. We know what the Fed's going to do, of course. They're not going to cut interest rates. That's been pushed back. The expectation now, this is pretty remarkable. Only one cut is what the market is expecting today. You and I talked early in this year. The market was expecting 6 to 7 rate cuts. Now we're down to one. They're saying perhaps it could occur in September, but a lot more chatter saying maybe the Fed doesn't cut at all. So I'm going to dig into some of the positives and negatives here, and then you tell me your thought on where we go with higher or longer. Obviously, the clear negatives are going to be for anyone borrowing money or looking to borrow money, right? Credit card rates already at all-time highs. I know this is always number one for you, Peter, saying eliminate this first, right? We're at 21.6% record high in terms of credit card rates. As long as the Fed stays high, this is going to stay higher for longer. Credit card delinquency rates, obviously likely to continue to go up. Looking at car loans here, highest rate since 2001, 8.57%. We've seen a huge impact on demand because of this higher interest rate. Most people finance the cost of a new vehicle. I think it's over 80% of people. And then, of course, the housing market getting hit in terms of the slowdown. Most people finance the cost of a home. We're at 7.17% today in terms of the 30-year. Just a few years ago, it seems crazy, but we were below 3%. Okay, before I talk about some of the positives here, Peter, what do you think about this concept? Obviously, we don't know the Fed could cut rates at any point, but for now, it seems the market's getting more comfortable and used to the fact that we're going to be higher for longer, and we have to do that because inflation is probably going to stay elevated for longer than people thought.
Yeah, three groups really struggling or on the brink of struggling. You've got people in the worst shape are people with high credit card debt. This is really devastating to them, fuel to the fire. The typical American bought a house. Many of them counted on rates dropping, didn't work out for them. Some are in the homes they probably can't afford. Someone like to move, they can't afford to move. So it's hitting a lot of Americans there. First-time home buyers, very, very difficult because a lot of homes not for sale because the people that leave those homes would need to buy new homes and don't want to buy at higher rates. And young people can't afford to pay these rates. And so you've got a whole generation squeezed out of the market right now. And we've got commercial real estate where the higher net worth folks are. A lot of them have been hanging on, making their monthly payments in upside down commercial properties. And they're looking at the future and going, you know what, there might not be a way out of this. Hand it back to the regional bank. Regional bank can't take all these losses. And that's kind of your recipe for disaster. So you've got three very different groups, all not sitting in a great spot right now.
Yeah, and the reason the Fed can do this for now is, of course, the economy is still expanding. We got a GDP print that was below expectations, but still in an economic expansion. Wage growth still strong. Employment report, we'll get another one this week, but it seems like employment is going to continue. So still the threat is inflation. And so I actually agree with what the Fed is doing. I didn't think they should have been aggressive in cutting rates to begin with. Now, who is actually benefiting from this higher for longer? I think anybody who doesn't have this type of debt, who's actually sitting on a big savings account, anybody, and that includes corporations as well, right? Companies like Microsoft and Google and Apple, they have these enormous cash balances. They've locked in this financing at very low interest rates in 2020. So they're actually benefiting from the fact that interest rates are staying higher for longer. And if we look at the Fed funds rate here above 5%, that does seem extreme compared to recent history. But if you go back to the 90s and 80s, this was a very normal rate of interest that people could expect. It was only during that period where the Fed kept rates at 0% for 7 years and continued to keep rates low well after the economy was expanding. It feels high only because we were living through such an abnormal period.
Yeah, 100%. I think that if we look historically, not a big deal, but the issue is people made decisions based on today's set of facts, not 20 years ago set of facts, and so it's a different type of problem.
It's the rate of change too, and
That's
like you
right.
said, in terms of the commercial real estate market, they were not prepared to live in a normal environment, and I think that's just a cycle. We'll focus on that on another episode. That's just going to take a long time to go through, and every single month we're seeing that debt come due. And if you have a property where you're upside down and you owe more than the property's worth, as you said, goes back to the bank, and that causes more problems. So I think that's just a cycle that has to play out, but ultimately it's a good thing. We get a repricing, and higher interest rates by themselves are not necessarily a bad thing. We saw it throughout the 80s and 90s. The economy can do okay. Corporations can do okay, even with higher interest rates. And we're seeing that again this earnings season with S&P 500 earnings hitting another record high this quarter. So let's move on. Number two, an insult to drunken sailors. Peter, I don't know if you knew where this saying came from, but back in the 1700s, these sailors would be away at sea for long periods of time. And when they came back, they just went on a spending spree when they came ashore, but they were actually limited, right, by the amount that they had or the credit people would extend to them. So there was an end to that debauchery that the sailors would often partake in. But the U.S. government, not so. We seem to be just continuing to escalate higher in terms of the national debt. We just passed another $95 billion aid package. How are we going to pay for it? Well, we're going to borrow more money to pay for it. And whether you agree with where we're sending it or not, it's clear we don't have the money, the existing money to pay for all this stuff. And if we look at the budget for 2025, at least the proposed budget, $7.3 trillion. So here's the big debate. Is it that we don't have enough revenue coming in and we should raise taxes, or is it that we have a spending problem? I'll give you my take. It's a spending problem, clearly 100%. If we look at government spending over the last 23 years from 2000 to 2023, it increased at a rate of 5.3% per year. That's more than double the rate of inflation per year, which was at 2.5%. What's your overall take here, Peter, on this, just the continuation of kind of spending without regard whatsoever to do we have this money and what will be the impact in the future?
Yeah, I mean, does any reasonable person believe that no matter where you set the revenues for the federal government, it doesn't matter if we increase taxes to 80% or 70%, politically, just set all that aside, whatever we increase revenues to, does anyone believe that Democrats or Republicans would actually run a balanced budget and actually not spend more than they collect? Democrats, Republicans, doesn't matter who's in Congress, who's in the White House, they've both shown repeatedly over and over again they will spend more than comes in. And the reason is there's no consequence to their spending. It really is like they get a credit card, get to do whatever they want, and some other generation will have to deal with it. That's not really very healthy, and that's the problem is we don't have the incentives. There's a tremendous incentive to spend. You can do whatever you want, support whatever war you want, do whatever program you want, support your constituents however you want, and there's not a consequence that you deal with today. Somebody else has to deal with it, or the value of the dollar is diminished. And I think everyone reasonable knows the government is not going to match revenues to expenses. And until then, really it's hard to get enthusiastic about dramatic rate hikes because the idea of it is it will solve a problem, and every rational person knows it's not going to solve the problem. The real problem is spending without consequence over the short term.
So it seems to be an issue. We're familiar with this in the finance world of skin in the game and the lack of it, right? Both on the political side and their constituents. Nobody has to feel any pain in terms of
Right.
spending this money in the immediate sense, right? If we want to fund this war in Ukraine, keep funding it. Well, you don't have to pay any more taxes. You don't have to worry about it. You don't even have to fight there. We'll just send the money there. Much easier to do that when there's no skin in the game. But the big proposal here that's part of this budget, Peter, is big tax hikes. We're looking at tax hikes for corporations, for wealthy individuals. And there's always this saying that kind of annoys me because they never show the data of it, that people aren't paying their fair share, that people and they've kind of focused on this number of 400,000 and above. And that was what they focused on in 2020. They're still saying it. They haven't adjusted that number for inflation, which would be closer to 500,000 today if they did so. But there's a sense that if only those people paid their fair share, we'd be okay. And so I just want to give this statistic here to kind of set that point, set it and forget it, because this is the actual data. 43% of US income tax filers earning 50,000 or less make up 10% of the total income that's made in this country. And what do they pay in taxes? Negative 4.8%. This is at the federal level, right? It's negative because they're getting a refundable credit, the earned income tax credit and other credits. 10% of taxpayers earning 200,000 or more earn 44% of the total income, and they pay 80% of the federal taxes. So you can see the disparity here in this chart. The higher the income, it's a very progressive system already. The higher your income, you're paying a much higher percentage in terms of the taxes paid as compared to the income that is made. And if we go to the bottom group, which they're saying, well, this is the group that's getting hurt. Well, in recent years, it's gone in a direction that's increasingly progressive, which I would argue, well, this group that's getting this negative tax rate, well, they're not going to care as much about, obviously, spending more money and increasing national debt because they're not paying any taxes in the first place. What do you make of this? Do you think that we need to increase the tax system, make it even more progressive than it already is when we've been trending in this direction? If we look at where we were 20 years ago, Peter, the top 1% was paying like 33% of all taxes, and now they're paying over 45%.
All right. Well, there's a lot going on here. So I think first there
Yeah.
should be a progressive tax rate. If you benefit more from all the great things this country has provided to you, all the great opportunity, you should be paying more. So I would say that. I'm not for like everyone should pay 14%.
You're not a
But
flat
second,
taxer like me.
right. But I think that I also think that the reality is taxes are higher than people think. People that are making a lot, I can tell you, as someone that works with an enormous amount of high income people, high net worth people, they pay much more taxes than people think. And if you look at where a lot of high net worth people are, for example, New York, California, their overall income tax rate is over 50%. So they go to work, and every dollar they make, more than half of it goes to the city they live in, the state they live in, and the country they live in. More than half of it. And then they take what's left and they pay property taxes on their house and their cars. And then when they die, and then if they sell something, they pay a capital gains tax. And then when they die, they pay an estate tax. So they are definitely paying taxes. There's this mythology that they're not paying taxes. They most certainly are. And so I think it makes for divisive politics to say, hey, we're just going to take this group of people, we're going to tax them another 10%. Well, you got to remember, they're paying state taxes, sometimes city taxes, and they are paying other taxes. So you're really taking them to 60+%. And at some point, it becomes a little bit ridiculous, right? I mean, if somebody's super successful, like Taylor Swift, right? Okay, fine. She can pay half her money in taxes, but should she really be paying 75% of what she does in tax? At what point does she go, you know what? Maybe I just am not going to tour. Do you know what I mean? So I think that there comes some point where you will stifle productivity. I don't know where that point is, but you will reach a point where someone will go, you know what? I'm not going to put my money at risk to start a business, or I'm not going to work those extra 5 years if instead of giving half to the government, I'm going to give 65% to the government. There is that tipping point. I'm convinced the government is on a mission to find out what that tipping point is.
No question that there's a level, and we don't want to find out what that level is. And people can vote with their feet, at least at the state tax level, but the federal tax level, obviously harder to do that. But if we're looking at the proposal here, this was the big one that got a lot of attention. Not likely, I think, to be passed. Certainly not going to be passed in the current form. It would need changes in terms of the powers in terms of the November election. But part of the tax hike increases proposed was this capital gains rate, moving up to a record high, which would be 44.6% all in for the highest income earners. And this, to me, would be absolutely disastrous for asset markets, for stock markets, for anything, if you're going to be paying almost half, and this doesn't include state taxes, right? If you're in New York or California, you're going to be well over 50% all in. I don't think this is going to happen, but is the capital gains rate too low today at 23.8% all in? Or does it need to be higher? Is this a way to fix our fiscal situation?
Like I'm probably in the minority camp here. I think income taxes should be lower and capital gains taxes should be higher, and the average American should pay about the same. But what it would do is it would make it more equitable among classes. Because the reality is, the people that have capital assets tend to be the wealthiest people. They're invested in real estate, stocks, private equity. They're paying the lowest tax rate that exists in the United States. A doctor going to work, making $600,000 a year is paying the highest tax rate that exists in the United States. Does not seem reasonable to me. I think the doctor's paying too much. The private equity guy is paying too little. Overall, the tax rate should be lower overall, but I think there needs to be a closing of the gap. This proposal is absolutely ridiculous. At a state level, people will be paying over 50% in capital gains. You live in San Diego, you sell your house, you've got a big capital gain, only part of it's exempt. The rest, you're going to pay 50%, more than 50%. I think in California, you pay 58% in taxes. I mean, give me a break. It's so punitive. It would be begging for a lack of investment. No way it passes.
Yeah, absolutely. It would crush. It would absolutely crush a number of different markets, and I don't think, coming back to the original question, I don't think it's going to balance the budget. And
No.
the big question is really, is the government such a good steward of this money that they deserve more revenue? And if they're not, we have to deal with that spending issue that we first talked about, not the revenue side. But I want to end with this section with just this chart here. This is going to be the elephant in the room. It is not today, but at some point it will be. It's just the interest we're paying on that national debt. It's over $1 trillion. This has not stopped anyone. So what people ask me, well, what's going to happen in this chart? It's going to go higher because until it reaches a point where it's impacting us in terms of, oh, we can't spend money somewhere else, which doesn't seem to be the case yet. Unfortunately, I think, Peter, it has to go higher. Okay, I want to go to section 3 here. Not all risk is rewarded. This is a concept you and I have talked about with a number of different areas. Today, I want to focus on long-term bonds. This is from your book, a quote here: "In an environment like we have today, long-term bonds are very, very dangerous." And you just point out some simple math here. Obviously, when interest rates rise, if you have a high duration in terms of your bond, you're going to get hit. And if we look at the longest duration zero coupon bond ETF, the zeros, that's duration around 25 years, Peter, which I know a lot of people, what does that mean? Well, if interest rates go up 1%, that means you're losing 25% in that instrument. And not only did they go up 1%, they went up a few percent. So this is comparing that investment to an investment in a treasury bill ETF. You could see the difference in volatility. Much higher volatility in long duration bonds over the last 4 years, actually higher than the stock market. Treasury bill ETF, obviously almost no volatility. So what the efficient market people would say, well, this is higher volatility, this is higher risk, you should be rewarded for that, hasn't been the case. It's been the exact opposite. Obviously, if you're sitting in treasury bills, not a huge gain, you're up 8%. But if you're in that long duration bond ETF, 56+% decline over the last 4 years.
Yeah, I guarantee you that there are people that did not know they could lose that much money in bonds. And even if you hold the bonds to maturity and you go, "Oh, I didn't lose any money," you hold these up for the 25 years, you got crushed in terms of purchasing power. Before you buy any long duration bond, make sure you understand the risks. They are very real, in my opinion, much more severe than the risks of investing in the stock market, where you have more volatility, but the risk of losing your purchasing power much, much, much less significant.
At least you have some upside and
Right.
potential upside in the stock market. Here, you're buying these things at less than 1% interest, locking them
Yeah.
in for 25, 30 years. What I like to say is, unless that is the duration where you intend to hold it, you shouldn't be owning that bond. But that comes to it back to an important point. Peter Lynch, I always show this quote, but know what you own and why you own it. And at Creative Planning, that's the number one thing we do. Our advisors are going to walk you through every single thing in your portfolio and make sure you absolutely know why it's there, what its purpose is, why you own it, and that it meets your goals, and that it's tied to actually your duration in terms of your holding period and distributions. And so if you're looking for advice on your portfolio, a second look, reach out to us today. I'll have a link in the show notes. 300 billion plus in assets under management and advisement. We're in all 50 states and we're here to help. So definitely reach out. Last here, Peter, signal or noise. We got this rising correlations here. Correlation between stocks and bonds over the last 3 years, 0.7. And for people who aren't familiar with correlations, if it was 1, it would be meaning they're moving exactly in tandem. This is unusually high. It's a record high here for going back to the 1970s. We've never seen stocks and bonds move together this closely on a monthly basis. And the big reason for this is that the risk of interest rates rising and higher inflation over the past 3 years has been the big threat to the stock market. Now, what I want to point out before I ask you if it's signal or noise, correlation is not the same thing as returns, as you can see here. The last 3 years, stocks have done pretty well. They're up 26%. Bonds, on the other hand, if we look at the aggregate bonds, actually down 10%. So how is that possible, even though they're highly correlated? Well, when stocks have been up, they've been up much more. And when bonds have been hit, they've been hit hard and haven't recovered. So back to this correlation chart, we're getting a lot of questions about, we talked about this last year in terms of the 60-40 portfolio. Are bonds not the diversifier that they used to be? Would you read anything into the correlation over the past few years in terms of having this type of portfolio going forward?
I wouldn't, because I think when you look at the short run, what impacts the correlation here is exactly what you said, which is we've got both asset classes being highly influenced by short-term rates, but we know that those factors are going to change over time. And we'll go back to a world where stocks and bonds react differently, because normally what hits stocks, terrorist event, a cyber attack, a war, some kind of crisis, COVID, whatever, is going to have the absolute opposite impact to the bond market. And so I'm going to say noise. I'm curious what your chart's going to say here.
Yeah, that's a great point there, because usually it's a deflationary type of event. And you'll see interest rates fall and bonds will rally. What I would say is you never want to look at past correlations in terms of predicting the future. As you can see here, if you did that a few years ago, you would have said, these things always move in opposite directions. Well, today we're at that extreme. If we look at where we were in the 90s, let's say, it didn't stay high forever. It eventually came down. Stocks and bonds did just fine. And the overarching point I would say is the bond market's in a very different place today than it was a few years ago. If we're looking at the yield on bonds today versus where they were in 2020, we're looking at close to 5% yields versus less than 1%. So night and day. And so regardless of whether they continue to move in the same direction, you're at least being paid today for that risk in bonds. You're being paid above the actual expected inflation rate, which is a pretty good thing. But never use prior correlations as a predictor of the future. And I suspect when the economy starts to soften, which eventually it will, you're going to get a more normal relationship in terms of stocks and bonds. And if that inflation fear becomes removed, which it should, if the Fed sticks to their guns and keeps rates high, that more normal correlation will exist. But if you're owning bonds, back to that point, make sure it's tied to your duration in terms of how long do you have to invest, because you don't want to be in a situation where you're forced to sell bonds in this type of drawdown. But next 7 years for bonds, much better than the past 7. That's very, very likely given where interest rates are today. All right, Peter, covered a lot of ground in a short period of time there. Thanks, everyone, for joining us. If you're watching this on YouTube, take a moment, hit that subscribe button, hit that like button, leave a comment. I read all of the comments, try to respond to as many as possible, and we'll see you next time on Signal or Noise.